Hello and welcome to the lecture for Chapter 6. This chapter, as you can see, covers planning of the audit, which involves getting an understanding of the client so that you can properly assess risk and then responding to that risk. So we'll talk about major steps in the audit process, the process of accepting a new client, the actual planning that goes into an audit and why you do that. Talk about risk assessment procedures that we can use to gain an understanding of the client and the industry that they're in. We'll talk about assessing audit risk and materiality. Materiality is going to be the level at which we would accept mistakes below a certain dollar amount. Talk about fraud risk, and then further audit procedures in response to risk, and then substantive portions of the audit plan, meaning actual tests that we do looking at documents, that sort of thing. So an overview of the audit process, and we'll talk about each of these in more detail. The first step, of course, is to plan the audit. What are we going to do? Who's going to do what on what day? Those kinds of things. We're going to want to really pay attention to whatever we can do early if possible. We want to get an understanding of the client and its environment. So what's going on with that industry? What are the trends in that particular industry that might be putting pressure on that client that would change the risk? What do we know about the client? We'll talk about that more in a minute. We'll assess the risk of material misstatement. Based on that, we'll perform further audit procedures, so observing inventory, checking receivables, all of those kinds of things. And then all of that is with a view to the final step, which is forming an opinion and issuing a report. So engagement planning. So the first reason to get involved in engagement planning is to identify risks of a material misstatement. So what is that? We talked about that as blowing the audit, right? Giving a clean opinion to something that has a material misstatement in it. And so we need to say, when we engage a new client, and even existing clients that we return to, what are the foreseen users? So the first time we do an audit, that's pretty extensive, figuring out who are all the people these financial statements are going to go to, and what are they using the financial statements for? Are they contemplating large loans, investments, acquisitions, those kinds of things? So shareholders, lenders, all of that. And then what's the nature of the business relative to that risk? And then based on that, we'll design test procedures. So there are substantive tests, that's where we're looking at evidence and documentation, and then control tests. How are things supposed to work, and did they actually work that way? So risk management activities, the risk again is that we're going to blow the audit. So the first step is choosing whether or not we should even accept a new client or continue with an existing client. So when it comes to accepting a new client, we'll get management's permission first in writing, give that to the predecessor auditor and say, we need to talk to you about why you're not the auditor for this company anymore. And the reasons could range from benign, meaning the previous auditor felt that the client had grown beyond their capability of doing the audit, or maybe the firm changed partners and the new partners don't do audits, they only do tax. There could be reasons that are perfectly valid, or there could be disputes that the auditor had with the client where they disagreed about major estimates or about accounting treatment of certain transactions, to where they quit. And that would certainly be good for you to know if you're stepping into that mess. We would perform background checks. So any of the top people in the company, the people involved in the accounting, we would run criminal background checks on them to find out if any of them have fraud in their background that would cause us to be concerned. And then we will make inquiries with relevant parties. So talk to the bank, talk to the firm's general legal counsel about how things are going at the firm. Kind of try to take the temperature as much as we can. Sometimes the best course of action is to not accept a new client based on a risk profile. So then we'll go through the process of determining independence. We talked about this, I think, in chapter 4 or 5, what is the situation with all of the people in the firm that are professionals? What's the situation with all the partners in the firm? What's the situation with the covered members, the people engaged in the audit? What stocks do they own? Are they direct investments, indirect investments? What outside activities are they engaged in that might overlap with this client? So going through and testing to make sure that we are independent in fact, and make sure there aren't any issues that would cause us to lack independence in appearance either. So that's the first step. Are we capable of independently auditing this client? So the next step is competence. So what is the complexity of this audit? Have we done audits of this kind of client before? To what extent do we need to bring in specialists? Is this the kind of vanilla audit that we've done years and years? There's never been a problem. This is a good job that we can put our new staff auditors on, people that are just out of college, to gain experience? Or is this the type of audit where we need only highly experienced people in this particular industry, that sort of thing? So how can we get comfortable with that? And then we'll prepare an engagement letter. So that's a letter that happens before any work begins, that lays out clearly in writing what the objectives of the engagement are, what management is responsible for doing, and the key thing there is that management's agreeing to provide you as the auditor access to everything, the ability to speak to any employee, look at any record, look into their database. All of that is accessible to you. Make sure that's in writing. And what are the auditor's responsibilities? So what are they required to do? What are they held accountable for? And then if there are any limits on the engagement. So maybe you're being engaged on January 10th, inventory has already been taken and subsequent transactions have occurred, so you can't count inventory. That would be a limitation that should be documented. So the audit plan is like any other plan of a complicated process. It's going to describe who's going to do what, when, the sequencing of those things, how long each task is going to take. As you perform audits over years, you begin to get a feel for how long things should take. And recognize that the first year is going to take more time than subsequent years, all of that. And then try to figure out what you can do in advance. So if you don't show up for the audit until December 31st when they're counting inventory, and that's the first thing you're doing, you've got a ton of work to do to get that done by, say, the first week in March, when most companies would want to publish their audited financial statements. So what can you potentially be doing in October and November and December to get ready for that audit? Can you document internal controls and do interviews and fill out questionnaires about internal controls? Can you maybe do audits of accounts that don't get very much activity in them? Maybe the company isn't doing a lot of fixed asset work, and so you can look at their fixed assets and depreciation schedule. And then when you come in December, just look if there have been any changes since November 30th and December 31st. So what can you do in advance? You'll do a risk assessment, so you'll use analytical procedures to see where there might be deviations between either historical figures, benchmark figures from competitors, or industry benchmarks, and management's own expectations. So what are some areas that we did that in the last chapter that might not quite smell right, that we want to look at a little more? We'll determine the necessary tests that are required for each element of management's assertions and determine materiality. We'll talk about that more in a minute. And then we'll use this for quality control, supervision, and documentation. So if you're a staff auditor at an auditing firm, know that there isn't an unlimited amount of time to do a perfect job and trace everything down to the penny, that there's a balance of being efficient and being effective and doing a good job. So you'll be judged and you'll be asked to work on other jobs and promoted and all of those kinds of things based on how quickly you're able to do your work as well. So staffing in the engagement, there's going to be an engagement partner. That's the person that has probably landed the client, that has a good relationship with them. They'll be the ones that give them the final report at the end, maybe deal with any high-level disputes that exist between the auditing firm and the client. There's an audit manager. They'll be overseeing multiple audits at once, and they'll be making sure that they're the level right below partners in the firm, so they're very senior people that have a lot of experience. So they'll be monitoring the progress in each of the audits, dealing with any disputes that arise. There's a quality assurance partner, so that's another partner in the same firm that's going to look over the working papers when they're complete before the opinion letter is issued, and kind of a second set of eyes that should be objective to see whether or not the audit was done properly. Remember, all partners share in liability associated with these audits. And then there's audit staff. That's the people on the ground collecting information, completing working papers, and actually doing the job. Many times there are audit specialists, especially if there is complicated asset valuation or inventory valuation questions or technology issues. We might bring in other people. And then in some firms, depending upon the independence of internal auditors, we may be able to rely on some of their work. Primarily cases where the internal audit staff reports directly to the board of directors as opposed to reporting to someone within management. So the time budget, that's how long each of those tasks are going to take. And again, we'll compare what the actuals were against the time budget. The time budget's going to determine how much we bid on this audit. So, like any other cost accounting objective, we're going to provide a service that's going to involve a bunch of different people over a period of time. And how much are we going to charge for that service? Well, it's influenced to some extent based on who's going to do what, how much are they paid, how long does it take them. So you can imagine a spreadsheet that might contain all of that. So if we routinely spend a lot more time and have people that get paid a whole lot more than what we planned, and we're undercharging for our audits, we're not going to be in business very long. So that's part of it. Then we'll have our year-end work, so observing inventory counts that are taken on December 31st. We have to be there physically for that. Monitoring cutoffs, making sure invoices in one period aren't recognized in a different period, all of that. We're going to identify problem areas in advance and make sure that we bring in the right people to staff the audit. And then we'll use it to evaluate staff for efficiency. So that's, if you're a junior auditor, that's how you'll be judged. So materiality, again, a partner in a firm would set the level of materiality oftentimes, and that's based on their experience, their overall appetite for risk in the firm, and all of that. But it's a specific dollar amount, and there's going to be a specific dollar amount for the financial statements as a whole. So for this company, based on their size, I worked for a company once where the auditors told me the materiality was $50,000. So any one item could be off $50,000, or an accumulation of errors on a variety of items could be off $50,000. And given the size of the company, they wouldn't require us to make adjusting journal entries in order to get a clean opinion. So that's overall materiality. Is it will keep track of all the things we find as auditors that are not right and add it up, and that will tell us, do we go to the mat on this and require changes, or are we okay? So of course that's going to be based on the firm, the industry they're in, and the auditing firm's appetite for risk, all of that. So some rules of thumb: some companies will use 5 to 10% of net income before taxes. Of course, it depends on, if the firm is near break even, that isn't going to be one that works. 0.5 to 1% of total assets, 0.5 to 1% of total revenue, or 1% of total equity are all different kind of amounts that firms have used in the past for coming up with materiality. So there's that overall materiality, and then there's a smaller or lower level of materiality, meaning you won't put up with as big a mistake for some specific assertions. So as an example, my company had a $1 million line of credit with Columbia Bank, and it was secured by receivables and inventory. So Columbia Bank was a clear foreseen user of our financial statements. They were basing their loan to me on 2 line items on my balance sheet. So those line items probably had materiality levels set by the auditors that in addition to the overall level of mistakes, we can't accept a level of mistake on either of these 2 things at some lower level than the overall level of materiality. So audit procedures are used for 3 purposes. One is to get a better understanding of the client and the risks associated with the client. Another is to test the effectiveness of a client's internal controls. We'll talk about that more in chapters 8 and 9, but part of that is going to be, are their controls designed properly? So are the controls written in such a way that they'll catch the bad behavior we want them to catch? And the second is, are they operating effectively? Meaning, are people actually following the internal controls, or are they finding ways around them? And then it's to produce evidence to either agree with or disagree with management's assertions about this cash really exists, this inventory is really on the shelf, these assets are really owned by the company, all of that. So substantive test, so as opposed to control tests, so tests actually looking at account balances and that sort of thing, come in 2 forms. One is analytical, so we've talked about analytical procedures, comparing balances over time to benchmarks, all of that. That's very efficient. But then, so you can do that fairly quickly, but it's not super effective. There could still be things in that number that aren't quite right. So a test of details is taking a representative sample of what is in that particular account, the transactions that have flowed through it, and then looking at each one individually and testing it, trying to find third-party documents that can give you assurance that that really happened as it was described. So those are more effective, but they take longer. So auditors usually focus on cycles. So they'll look at revenue and collection. That's receiving an order, fulfilling an order, invoicing a client, getting paid by the client. Acquisition and expenditure, buying supplies, buying labor, buying raw materials, incurring expenses for rent and paying those, so paying liabilities, all of that. Production cycle is the conversion of raw materials into finished product. How are we accounting for that? And then finance and investment. So where are we getting money from? How is it being spent? Those kinds of issues. So we are responsible for doing at least a standard duty of care to find fraud. So there's 2 different kinds of fraud. One is fraudulent financial reporting. That's where there's pressure on individuals to show a certain financial result, so they alter the books or create false transactions to make it look like they've reached that benchmark, or maybe they get bonuses if they reach that. I've worked in companies where that has happened. And then there's misappropriation of assets. That's where people steal, take company assets as their own. So those are 2 different kinds of fraud. So some of the things we'll do to try to find that is, one, we'll brainstorm with engagement personnel. So at the beginning of an engagement, the audit team will sit down and kind of brainstorm about all the ways that this particular client, that fraud could be going on. What have we seen at other clients? What have we read about? That can help us think of things that we should be looking for. We'll interview management and staff. We'll do analytical procedures. Again, if there are anomalies that we see in our analytical procedures, that might point to something problematic. We'll consider other fraud risk factors. Sorry about that. Understanding how management is evaluated can influence fraud risk, right? And then alterations and audit procedures would flow from that. So what should we do differently? So there is a Z-score. I think most of you have covered this when you took your statistics score, but it's a way to quantify the risk of misstatement due to fraud, or the risk that a company may become insolvent. So there's 2 different directions that we can test in looking at an audit trail. So we may go from the financial statements and work our way back to the transactions that support that financial statement. Or we may go in the other direction. We may start with records and then trace those to find them on the financial statements. So we either start with the statements and work back to the transactions. That would be telling us if it was complete. Or we start with the transactions and find them on the final trial balance. That would tell if we've understated something. So we're going to be more worried about assets and revenue being overstated, more worried about liabilities and expenses being understated. Those are usually the directions that companies will fudge things. So substantiation of account balances, we're going to make sure that assets actually exist and that the company has legitimate rights to those. We'll document that, take pictures of assets, take copies of titles to the assets, that sort of thing, or sale contracts. We'll establish completeness, so have all of the liabilities, are they all reflected in the trial balance? Are there any unreported liabilities? That would be a concern. We'll verify that the cutoff was handled properly, so transactions in 1 year are recorded there, transactions in the next year are recorded properly in the next year. Companies will often, especially if they're near break even, play games with pulling sales from the first week of January into the last week of December. We'll look at valuing assets, making sure that estimates are reasonable and that we haven't inflated the value of our assets. And then we'll also look at financial statement presentation. So as an example, are long-term liabilities classified that way properly, or have they been altered? And then disclosures. So that's the end of the lecture for Chapter 6. I will talk to you again in the lecture for the next chapter. Thank you.